Hi everyone, welcome back to the US Individual Taxation Classes Enroll Agent Part 1. In this particular video, which is very interesting, I'll be walking you through what all advice you can provide to the individual taxpayer in United States of America. This is very interesting and would be the crux of what all we have learned so far. Now it's a time for advising the individual, and as an enroll agent as well as the tax practitioner, we love to advise, right? So let's dive into to understand more in detail.
Hello everyone, welcome back to the last class of chapter 4 US taxation. So before we went on a break, we have covered these couple of items. Quickly walk you through same. So we have started with tax planning, understood what is tax planning for the individual means, reporting requirement, and then these are like 11 items on which we need to be considerate for the tax planning. Before we went on a break, we covered sale of property, planning of education, planning of estate, and now we are starting with planning of retirement. Then we go for divorce, marriages, future and past tax returns which you have already filed, and the planning of estimated tax penalty or avoidance of any taxes, and then tax planning for adjustment, deduction or tax credit, and then filing status, planning of health insurance, and lastly social security income. So this section will be covering through the book, so I'll make the notes and send it to you late tonight, but at least we can walk through the key contents which is already available in the book. So now jumping on to the retirement planning, which is like we have already discussed like a couple of things. Majorly in this we discuss about traditional retirement plans as well as Roth IRA. In the traditional retirement plan, we have discussed in detail, there are two categories, deductible and non-deductible. In addition to that, the company employer also do offer 401k plans. So as an individual, you can choose either a traditional IRA or a Roth IRA or 401k plan, 401k plan, or any such plan. But couple of things you need to be keep in mind is about like distribution timelines and distribution age. If you remember the Roth IRA, they have distribution age of 72, right? So you need to keep in mind what are the distribution age, and some of the plans do have 59 and a half is the age. So those things you need to keep in mind when the individual would be needing the money. Accordingly, you choose the plan. Second important thing, if you see, review the beneficiary ownership situation, including taxability of the distribution to the beneficiary when these amounts are being taxable at the distribution. Some of the distribution are not taxable, like which we have discussed earlier also. If you are taking the early withdrawal for any medical reason or for any education, qualified education expense, then those are not considered as a taxable income, and there is no additional taxes or additional penalty levy on them. So those all things you should be considerate when you are choosing the plans. And then C point, if you see, the taxpayer who are age of 72 may request the trustee of the IRA to make a charitable contribution from the IRA on his behalf, because charitable contribution is not taxable, allowing the taxpayer to reduce the tax liability. So those, whatever the IRA amount you are receiving, you can request your trustee to make that as a charitable contribution, and that help you in reducing your future tax liabilities. So that's about like retirement plan. And now coming to the marriages and divorce, there also we have discussed earlier, there are two things. One is like alimony, which is like before 2018 and after 2018, and second important thing is the contribution you made for the child. So contribution which you made for the child is allowable expense, and the amount which contribution for the child, if anyone is receiving, that is not considered as a taxable income. That's one thing. And alimony, if alimony is being received for the divorce decree before 15th December 2018 divorce degree, then that is being considered into the income of the person who is receiving and expense of the person who is paying. Whereas after 15 December 2018, no alimony is being considered either as income or as an expense. Right? So marriage and divorce can have a tax impact in the year of divorce or in future year. So when taxpayer get married or divorced during the year, when the taxpayer get married, then he has a benefit to file the joint return, right? But when taxpayer gets separated, then he mandatorily have to file a separate return. So that also, you need to consider, and you need to update your employer as well, because he or she, like your employer, will be deducting the taxes accordingly. Because if you are married filing jointly, then the tax liability might be less, and your withholding tax which your employer need to keep might be less. Whereas if you are getting divorced and if you are getting separated before the year end, that means at the year end you might be filing single returns, right? In that case of scenario, your tax liability might be bigger. So you need to inform your employer on a timely basis so that your employer can do the appropriate withholding of taxes. For divorce settlement reaching on or after 1st January 2020, alimony is neither included, that we have discussed. Divorce settlement can be affected whether the dependent can be claimed for the taxpayer. So here, one more thing you need to keep in mind is the dependent. So who is claiming the dependent? So the person who is claiming the dependent, he will be in a tax advantageous position. The person who is not claiming the dependent would not be in a tax advantageous position. Transfer during the divorce may be taxable, including pension, annuity, other retirement plans, stock, brokerage funds. Also, if one spouse buy the property from other during the divorce, the income of sale of the property may be taxable. Right? Any doubt here? Marriage and divorce cases?
No doubt. Clear.
So, you need to update your employer. If you are getting married, then also you need to update employer. If you are getting divorced, then also you need to update your employer. And this alimony part 2020.
So within how many days?
Within 10 working days.
Yeah.
Yeah. And then the dependents who will be claiming the dependent, that should be clear for the tax purpose. Next one is item that will affect future past returns. That is carryover, net operating loss, Schedule D, Form 8801 or negative QBI carryover. Due to limitation of losses on current year return, many losses need to be carried out to the other tax return. That means carried forward losses. So it can be unusual capital loss, can be carried forward to the future year until they are used. It can be short term or it can be long term. Right? We discussed in chapter 2 in detail about carry forward of the capital losses, right? Short term losses, long term losses, netting off process. That also we have discussed, and then we discuss about the carryover process also. So short term and long term capital losses carryover must be covered, must be carryover used separately but are subject to same limit each year. Right? Hope you remember the short term gain, short term loss, netting off process, and the carry forward of the losses, which we discussed in chapter 2. Net operating losses that is arise in 2018, 19 or 20 can be carried back for the 5 year. And carry forward of the losses is always be infinite. But in the CARES Act 2020, it has been given an advantage to carry back up to 5 years. What is carry back? What is carry back?
तो कैरी बैक मीन अगर जैसे लास्ट ईयर की रिटर्न्स में हमने टैक्स पे करा है, तो अगर जो हमारा एनुअल नेगेटिव आ रहा है तो उसे हम फाइल कर सकते हैं टैक्स रिटर्न की, और उससे हमें जो हमारा टैक्स रिटर्न है उसका टैक्स क्लेम रिफंड आ जाएगा.
Yes, absolutely right. For example, in 2016 financial year, you have got a gain, net profit of let's say $1 million. And now in 2019, you got a loss of $500,000, right? So you can go back and claim this losses in the previous year, 2018. And where you have paid the taxes, now you can claim the refund of the taxes which you have paid. So benefit of carryback is you can claim the refund of the earlier year taxes which you have paid. So that can help you in giving more cash inflow or cash in hand. Make sense? Divya, Garima, Vivek?
Yes, sir.
Okay. After December 31st, 2020, the 80% limitation is applied. The farmer can enjoy 100% 2-year carryback that we have already discussed. A taxpayer with unused credit for prior year, minimum tax can carry forward to the next tax year, use form 8801. So to carry forward the tax losses, you need to file the form 8801. Any unused qualified business income deduction can also be carried forward. You need to use the form 8995 and 8995A or the IRS publication 535 to figure any losses carry forward to be applied to net carry forward losses. So any unused qualified business income deduction can be carried forward, but you need to file the form 8995 or 8995A or the IRS publication 535. Next one is injured spouse. An injured spouse is a taxpayer whose tax refund is appropriate for the past due debts of the spouse of the former spouse. So injured spouse is a taxpayer whose tax refund is appropriated for the past due debt of the spouse or former spouse. The spouse whose income is being considered as more taxable due to married filing jointly, but now they got separated. And now, hence, his or her individual income should have been considered less and should have been carried forward more tax credit need to be considered after the divorce, and appropriate credit has to be provided to the individual whose income is being considered as more taxable income in the earlier year when they were filing jointly. Next is innocent spouse. An innocent spouse can be relieved of the responsibility of paying taxes, interest, penalty if the taxpayer spouse or former spouse improperly or fraudulently reported item or omitted item on the joint tax return. So for example, husband and they file the joint return, right? And let's assume the wife may not have much understanding about the taxes and husband is manipulating, and husband is providing more taxes toward the wife's income, and now they got divorced and there is certain penalty levy on the wife's income. So in that case of scenario, IRS is being lenient toward the innocent spouse, but the spouse need to prove that he or she was innocent, and then there would not be any additional taxes or penalty levy on the undue or fraudulent income which has been shown in the married filing joint return in the name of the other spouse. Make sense? Yes, no?
Yes, sir.
Okay, so next one is estimated tax and penalties. So taxpayers are expected to make estimate tax payment for the current tax year if both of the following conditions are applying. When you need to make advance tax payment, first the taxpayer expect to owe at least $1,000 in taxes for current year after subtracting the withholding tax. For example, if an individual has estimated total tax of let's say $10,000, right, and he or she has already withholding tax, that means his or her employer has already withhold $9,500 taxes. That means the net tax liability which is being payable is less than $1,000. In that case of scenario, he or she is not required to pay estimated tax. But if withholding tax is, let's assume, $8,000 and estimated tax is $10,000, that means shortage is more than $1,000. In that case of scenario, that individual need to pay estimated tax in advance. Make sense? First point, A point. Is it clear? Yes.
Yes, sir.
Okay, now let's jump into the B point. Taxpayer expect that their tax withholding and refundable credit to be less than or similar of 90% of the tax of the current year tax return or 100% of the tax of the prior year tax return. That means if the tax withholding or tax which you have already deposited is equivalent to 100% of the tax liability which you have paid in previous year, or 90% of the estimated tax payable in current year. In that case of scenario, the taxpayer expect that the tax withholding or refundable credit is less than or similar to. In that case of scenario, you are not required to pay additional estimated tax. But in case if it is more than that, then failure to do so may result both underpayment and late payment penalty to the taxpayer, and the penalty for the substantial understatement of income is larger of 10% of the correct tax or $5,000, right? 10% of the correct tax or $5,000, whichever is higher. Make sense? There are 2 points. One is if your total tax liability after withholding tax is less than $1,000, then you are not required to pay estimated tax in advance. Or if your tax liability, estimated tax liability, you have already paid more than 90%, or you have already paid more than the previous year actual tax, then also it's not required. But if it is less, then in that case of scenario, you need to pay taxes plus penalty, which will be 10% of the correct tax or $5,000, whichever is higher. That means minimum $5,000 is the penalty. Any doubt? Vivek, Garima, Shubham?
Yes, sir.
Got it? Yeah, Shubham, Divya?
Yes, sir, it's good.
Right? So next one is adjustment, deduction, and credit for tax planning. So adjustment, deduction, and credit, which we have discussed in detail in chapter 2 and chapter 3. It's a quick reiteration of the same in view of tax planning. So taxpayers should plan in advance for certain adjustment, deduction, or credit to maximize their tax benefit. For example, like contribution to certain retirement plan. Contribution to certain retirement plan can be deducted, reduced, and the tax income on the return. In addition, taxpayer with lower income may able to take the credit of the retirement contribution. And then expenses for qualified education expense deduction, child care adoption, or certain other expenses of your child can be used for the credit. That also you can plan in advance. And taxpayer should ensure that they keep appropriate record to pay the expenses only as required by the tax law in order to have the tax benefit. So certain expense that you all know for the child care or education expense can be used for the tax credit purpose. Review of the financials and life change plan, which is, for example, marriage, adoption of new child, or birth of new child, or divorce. For that also you need to do appropriate planning in advance for the tax purposes. Next one is character of transaction. So capital gain versus ordinary income. This we have discussed earlier also in point number 2. Ordinary income tax is paid on earning from interest, dividend, employment, royalty, self-employment, whereas capital gain tax, which is generally lower tax rate, is paid on the income that is derived from the sale or exchange of an asset such as stocks or property. typically capital tax rate on the long-term capital gain are taxed more favorable because they are lower tax rate. So you need to appropriately identify the item which can be considered for the capital gain tax rate, and you should use the capital gain tax rate, as generally the capital gain tax rate are lower than the ordinary income tax rate. Next one is the filing status. This also we have discussed in chapter 1 very much in detail. All 5 category of the filing status: single, married filing jointly, married filing separately, head of the household, and qualified widower. And the most advantageous situation we all know is a married filing jointly and a qualified widower. Then after head of the household, then after single, and then least one is married filing separately. So all those things we have already discussed in chapter 1 in detail. So this is like the same thing. Go through at your own. Nothing new over here. The next one is like health insurance. Under the healthcare law, certain health coverage is called minimum essential coverage. A taxpayer generally cannot take the premium tax credit for an individual in their tax family for a month. That individual is eligible for the minimum essential coverage, except the coverage in the individual market. Minimum essential coverage may include the following. First one is individual market coverage. Second is most coverage through the government sponsored program, which is like Medicare, Part A and C, the Children Health Insurance Program, or certain benefit for veteran and their family members, so on and so forth. And most type of employer sponsored coverage, grandfather health plan coverage, and other coverage. So this also we have discussed in detail in chapter 3, where we studied about all the itemized deduction. So there we discuss about HSA, there we discuss about Medicare, there we discuss about healthcare insurance plan, right? So this is 100% same which we have studied, but here from the tax planning perspective, you need to advise your client the which health plan he or she should start taking at the inception, or when there is any change in the life circumstances, for example like adoption of new child, or birth of the new child, or maybe death of any child, or maybe let's say like marriage of the individual or divorce of the individual. So you need to guide your client that which insurance coverage he should be considerate for the family according to the size of the family, so that he or she can claim more and more itemized deduction on the respective plan. The last one is social security income. To find out whether an taxpayer's social security benefit may be taxable, compared to the base amount for their filing status with the total of one half of the benefit plus all their other income, including tax exemption interest. When making their comparison, do not reduce the taxpayer other income in any exclusion, like interest from the qualified US saving board, or employer provide adoption benefit, or foreign earned income, or foreign housing income, or income earned by a bona fide residence of America or Puerto Rico, right? The base amount of the various filing status is 25,000 if the taxpayer is single, head of the household, or a qualified widower. 25,000 if taxpayer is married filing separately and live apart from their spouse. 32,000 if the taxpayer is married filing jointly, or 0 if the taxpayer is married filing separately and lived with their spouse at any time during the year. That means you are living with your spouse, but still you are not trusting on him. Hence, the government says you will not get any benefit out of it. So these all things you need to keep in mind. So with this, we are done with chapter 4. Right? Any doubt? Anything you need more clarification? Yes, no?
तो ये जो लास्ट पेज पे हमने पढ़ा सोशल सिक्योरिटी इनकम, जैसे कि डिफाइन करने के लिए कि जो हमारी एसएसआई है वो वेदर इज टैक्सेबल और नॉट, तो हाफ ऑफ द सोशल सिक्योरिटी प्लस क्या है सर, ये जैसे कैसे डिटरमाइन करेंगे हम क्या?
Let me present the screen again. Social security income. When you get social security income?
Mhm.
After the retirement, right?
Yeah.
So to find out whether any taxpayer social security benefit may be taxable, compare the base amount of their filing status with the total. So how much social security income is taxable? Principally, when you receive after the retirement social security income, that is generally non-taxable. But to what extent it is non-taxable? One half of their benefit, that means 50% of the social security plus all of their other income, including exempt interest and foreign income, bond income, and everything. So up to that amount, it is being exempt. And the base amount for the various filing status is this much. That's what it means.
Okay.